Will down payment assistance raise my interest rate? Imagine being able to buy a home sooner because of help with your down payment. Many home buyers wonder if accepting assistance will make their mortgage more expensive. Let's explore how these programs work and what they might do to your interest rate. Down payment assistance programs are designed to help people cover the upfront costs of buying a home. They come in different forms like grants, which do not need to be paid back, or loans that do need repayment. These programs are especially helpful for first-time buyers or those with limited savings. When it comes to mortgage interest rates, they are mainly influenced by your credit score, the type of loan you get, and how much you are putting down. Usually, a larger down payment means less risk for the lender, which can lead to a lower interest rate. But with assistance programs, the situation can be different. Many assistance programs, especially those that are separate from your main mortgage, might result in a higher interest rate. For example, if you get a second loan for your down payment from a state or local program, that loan might have an interest rate that is 0.5% to 1% higher than a regular mortgage. This is because the lender or program provider takes on extra risk by helping with the down payment, so they may charge a higher rate to compensate. It is important to know that not all assistance affects your mortgage rate. Grants that do not need to be repaid usually do not change your interest rate. However, if the assistance is a loan that must be paid back, it could impact your overall financing terms. Government-backed loans like VA or USDA loans often have low or no down payment requirements and come with competitive interest rates. These loans include the assistance within the loan itself, not as a separate program. For example, VA loans are available to eligible veterans and often do not requiring a down payment or private mortgage insurance, and they have low interest rates. FHA loans, which are available to many buyers with lower credit scores, also allow for small down payments and usually have favorable rates. For Asian American home buyers, family support and personal savings are often part of the home buying process. Assistance programs can help bridge the gap when savings are limited. But it's wise to compare the total costs, including interest rates and fees, with and without assistance. If the assistance is a grant, it typically won't affect your mortgage rate. But if it's a loan, check whether it's a separate second loan or part of your main mortgage. Separate loans might have higher interest rates. Some programs combine assistance with your primary mortgage, which could influence your overall rate. Always ask your lender for a side-by-side comparison of costs with and without down payment assistance. Think about how soon you want to buy. Sometimes paying a slightly higher rate now can help you buy a home earlier and start building equity. In many Asian American families, saving for a home is a big goal, but cultural values around debt and thrift are strong. Accepting assistance might seem like taking on more debt, but it can be a smart move if it helps you become a homeowner faster. It's all about balancing the immediate costs with your long-term goals. In the end, down payment assistance can raise your interest rate if it's structured as a separate loan. But grants and some government-backed loans usually won't. The key is to get all the details from your lender, compare your options carefully, and choose what works best for your family's financial situation.